All right, let's dive right into this explainer. Today, I'm going to be stepping into the role of your personal financial advisor. So, for those of you who are aspiring young investors, high schoolers, or college students gearing up for a test on this stuff, I want you to listen closely. This explainer isn't just your standard exam review to help you score an A. Think of it more like a real-world cheat code for keeping your future wealth. Because let's face it, in the game of investing, knowing the rules is literally the difference between just making money and actually keeping it.
Here's our roadmap for today. We're going to cover the investor's tax, calculating gains and losses, the holding time clock, triggers and wealth strategies, a quick student practice simulation, and finally, the wealth building playbook. Okay, part one, the investor's tax. So most of us are pretty used to working for a paycheck and paying income tax on that labor, right? But what happens when money goes to work for you? To wrap our heads around this, let's look at a super simple beginner analogy. Imagine you buy a rare pair of sneakers for $100. A year later, you flip them and sell them for $300. You're probably celebrating that $200 profit, right? Well, hold on a second. A really crucial lesson in finance is that the government always wants a piece of that win. And the specific way they take that piece is through something called a capital gains tax.
And that brings us to a massive vocabulary term you're absolutely going to need for your exam, capital asset. Simply put, a capital asset is just something you own that can increase in value over time. And this definition is remarkably broad. We aren't just talking about cool sneakers here. This applies to the whole shebang. Everything from stocks in companies like Apple or Tesla, to cryptocurrency like Bitcoin, to real estate and even businesses. When you sell one of these assets for a profit, well, that profit is your capital gain.
Moving right along to part two, calculating gains and losses.
Now, to figure out your tax liability, you need to know exactly how much you gained or lost. And first, you need to know your cost basis. Cost basis? It sounds super formal, but honestly, it's just a fancy financial term for the original purchase price of an investment. It's literally just the amount of money you originally paid out of pocket to get the asset. That's it.
So, here is the foolproof three-step formula you need to memorize to determine if a sale creates a capital gain or a capital loss. Step 1. Find your purchase price. That's your cost basis. Step 2. Find your selling price. Step 3. Just subtract the purchase price from the selling price. Whatever's left over, that's your profit or your loss.
Let's test this out with a quick example for your exam. Meet Sarah. Let's say Sarah buys a stock for $500. Boom, that's her cost basis. A few months later, she sells it for $800. 800 minus 500 gives us $300. So Sarah has a $300 capital gain. Remember, the government doesn't tax the whole $800. No way. They are only interested in taxing that $300 profit.
All right, on to part 3, the holding time clock.
Listen, this timeline right here, I consider this the single most crucial strategy in all of investing. It's an area where you can literally save thousands of dollars just by waiting. The government actually divides your investments into two entirely different tax buckets, and it's based entirely on how long you owned the asset before you sold it. Point 1 is short-term. This is for assets you held for exactly 1 year or less. Point 2 is long-term. This is for assets held for more than 1 year. Crossing that magical 1-year mark fundamentally changes how your money is taxed.
Take a look at how wild the difference is here. Look at the heavy impact of short-term tax rates compared to the much lighter impact of long-term rates. Short-term gains, they're taxed at your regular income tax rate. It's treated exactly like the money you get in your normal paycheck. But long-term gains, the government usually rewards you with much lower tax rates. Depending on your income level in the U.S., your long-term capital gains tax rate could be 20%, 15%, or, get this, even 0% if your income is low enough.
Let's put this into perspective with two real-world investors. First up, Marcus. Marcus buys $1,000 worth of crypto and sells it 3 months later for $1,400. Awesome. He made a $400 gain. But unfortunately for Marcus, because he held it for less than a year, it's short-term. So if he's in the 22% tax bracket, he owes $88 in taxes on that trade alone. Ouch. Now look at Sophia. Sophia buys $2,000 in stock, but she holds it for 2 years and then sells it for $3,500. She has a massive $1,500 profit. And because she was smart and held it long-term, she might only pay a 15% tax rate. That's $225. Sophia made almost 4 times the profit Marcus did, but because of her patience, she secured a significantly cheaper tax rate.
Now, you might be wondering, why in the world does the government tax investment profits differently than the money I make at my job?
Well, governments want to reward stable economic growth. They actually want you to leave your money invested in companies and the economy for the long haul, rather than just day trading in and out all the time. And this brings up a super interesting ethical balance that investors have to navigate, right? On one hand, you have the civic duty of paying fair taxes to support society, but on the other hand, you're utilizing legal tax codes to maximize and build your own individual wealth. The rules are written to incentivize patience, so honestly, using them is just smart planning.
Okay, part 4, triggers and wealth strategies.
So when does the tax man actually come knocking? You don't owe a dime just because your investments are going up in value. Taxes are only triggered by a taxable event. A taxable event is a specific action, like selling your stock, selling crypto, trading one crypto for another, or selling a piece of property. But what is not taxable? Simply holding your investments while they rise in value. You could watch your Bitcoin double in price on your phone screen, and it doesn't cost you a single penny in taxes until you actually hit that sell button.
But hey, what if you hit that sell button and you actually lost money? It happens. That is called a capital loss. And believe it or not, this opens the door to an elite strategy called tax loss harvesting. Let's say Jake buys shares for $900 and sells for $600. He lost $300. Well, that loss can actually be used to cancel out other capital gains. Take our student Emma, for example. She makes a $1,000 profit on one stock but loses $400 on another. Instead of paying tax on the full $1,000, she gets to subtract her $400 loss. Now her net taxable gain is only $600. Obviously, losing money hurts, but strategically, it can significantly lower your tax bill.
And speaking of elite strategies, let's talk about the big leagues for a second. Have you ever wondered how billionaires avoid massive tax bills? They use a strategy provocatively known as buy, borrow, die. Here's the crazy breakdown. They buy appreciating assets like stocks or real estate. They hold them for decades, and they literally never sell them, meaning they never trigger a taxable event. Instead, they borrow money from banks, using their assets as collateral to fund their lavish lifestyles. Because borrowed money is not considered income, it is completely tax-free. So they keep the assets, they avoid the tax, and eventually they pass that immense wealth right on to their heirs.
Which brings us to part 5, student practice simulation.
All right, I'm putting my financial coach hat back on for a second. We're going to do a rapid-fire quiz to simulate your exam. Scenario A, you buy a stock for $1,200. Later, you sell it for $1,900. Do the math in your head right now. What is your capital gain?
If you said $700, you hit the nail right on the head. But here's the follow-up question. If you held that stock for over a year, what rate applies? That's right, the long-term capital gains rate. If your rate is 15%, you'd owe $105, letting you keep the vast majority of your profit.
Okay, scenario B, coming at ya. You buy crypto for $2,500. The market crashes, and you panic sell it for $2,000. You now have a $500 capital loss. How does this loss actually help you? Think back to our friend Emma. That's right, you can use this $500 loss as a tool for tax loss harvesting to offset any other gains you made this year. It legally lowers your overall tax bill.
And finally, part 6, the wealth building playbook.
We've gone through the definitions, we've crunched the math, so let's tie the whole shebang together. This explainer honestly doubles as a blueprint for your actual financial life. Here is how you simplify all these complex concepts into 4 basic steps. Number 1, start investing early. Number 2, hold your assets past that magic 1-year mark. Number 3, harvest your losses if you make a bad trade. And number 4, avoid unnecessary taxable events by just holding onto your assets. Take a teen investor like Alex. Alex invests $500 into a stock. 1 year later, it grows to $700. That's a $200 profit. If Alex follows this playbook and simply doesn't sell, that $200 grows completely tax-free. That is how you efficiently build lasting wealth. I want to leave you with one final thought about your own future investments, and it's a big one. The golden rule of finance is this. It's not just about how much money you make, it's about how much you actually keep after taxes. If you took out your phone and sold your entire portfolio today, would your gains be short-term or long-term? How much of your hard-earned money would the government take? Master these rules, be patient, and keep what is rightfully yours. Thank you so much for joining me for this explainer, and I will catch you in the next one.